Atocha Global Analytics. Please like and subscribe. Greetings, salutations, howdy to you all. I'm KT with Atocha Global Analytics. As always, Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. And I want to welcome you back to Forecast Friday once again. This is our once-weekly segment, and this is the Friday, July 14th, 2023 edition. So here we go. Today I wanted to highlight the broadening conversation regarding the challenges with commercial real estate and its impacts on banks, because this is really impacting our economy going forward. Just want to let you know, JP Morgan Chase and Wells Fargo both recently increased their provisions for potential losses in commercial real estate, which means the first and fifth largest banks in the world, that's the first and third largest in the U.S., they're both taking actions to protect themselves from what they foresee coming here. So, finally, people are starting to see the inevitable outcome of the Fed increasing interest rates so high and so quickly, combined with, the remote work revolution. And, so the logical question is, what's the impacts? What's the solution? So we'll leave the underlying causes of the inflation alone. Other than to say that there's a large percentage of economists that say the combination of the Fed rapidly enlarging the money supply without doing so in the conventional way, via bank lending, combined with massive stimulus spending in 2020 and 2021, that's the real reason we had the inflation. But of course, that doesn't address that shortages were not associated with that. So, the Fed is not solely responsible for everything. But anyway, you be the judge on all that. But discussing the remote work trend is pretty straightforward and pretty quick. Remote work is real. Remote work is very popular, and it is never going away. So that pretty much covers that. Okay, so let's look at what the reality is for commercial real estate by comparing the lending rates between two properties to get a sense of what the overall financing impact is. So here we have a quote from 2023 and something I happen to have in my files from something I worked on in 2019. Clearly there's a huge difference in rates. When I did this, I didn't actually calculate the difference initially. Ironically, at 3.62% higher today, today's rate happens to be almost exactly double the 3.61% that I got in the quote for 2019. So, one of the problems with the current market is that too many things are uncertain. Potential gross income, meaning every dollar earnable by an existing property, is way up. That's way up due to the inflationary changes and several years of strong economic growth. But the vacancy is also unforeseeable right now, especially with office buildings. But overall, effective rents for some property types beyond just office properties are way down due to vacancy and many other factors. Expenses, of course, are up. So NOI, which is what's tied to valuations, it's way down for many property types. Also, the capitalization rates have gone up for many property types. So we have several things in flux that all influence values here, If you've been watching my channel, you know that the appraisal weighting is a factor that can't be ignored in how things unfold either. For most existing properties that are income generating, which is pretty much everything included in that commercial real estate basket, then income, NOI, really matters. But the sales comparison approach will also matter for valuations of commercial real estate. Now, if there aren't many transactions or they're starting to show lower values, then lower NOI and values from sales can be contagious to the other properties' values in portfolios held by banks. So, and they slide down in value as banks elect to recognize these losses. It's a gradual thing. Lastly, you have to realize that investors don't just care about NOI. They also care about the pre-tax cash flow. So this is a scenario they fear right now. However, in referencing what JP Morgan Chase and Wells Fargo announced, Wells Fargo revenues were reportedly up. So it sounds like a good thing now, but it's not really. Their losses were higher. It's raised its allowance for losses associated with credit by almost $1 billion, $949 million. A bank also stated the associated revenue increased $1.33 billion over the previous quarters, which was primarily due to higher loan balances and interest rates. So, it's a cross current, but the fact that they are raising this provision and they've already got losses associated with credit by about almost $1 billion, and that's noteworthy. Similarly, JP Morgan Chase's revenue grew a bit from 642 million to 806 million from the first to the second quarter of this year. Huge banks. Of course, we know the bank acquired First Republic back in May. They reported a $1.1 billion credit loss associated to these credit losses as it's related to these relatively small portfolios of office properties. So both have decided to increase their loss provisions here to ensure an adequate coverage ratio. But the big banks, I'm sorry, are acting this way because they see pain ahead. But they are really the smaller fish where commercial real estate is concerned. The big holders are smaller regional and community banks. Those banks don't have the same stringent capital requirements, think buffers, that the bigger banks do. So regulators have been monitoring these risks at these banks too, since they have the higher exposure. Also lenders have been doing some workouts with borrowers to lessen the number of defaults and that sort of thing. So there's a lot of things going on. And here's an example of a default. Sternlicht's Starwood Capital Group. They recently defaulted on a $200 million mortgage on office properties. So that's just one particular item. Anyway, so this is a sickly canary in the coal mine. That canary is hacking and coughing, and we need to keep our eyes on this because at some point this is likely to become a real problem. And just another little snippet here. Nationally, the home sales volumes in June were the lowest in a decade. Prices are holding up nicely, but the volume was the lowest in a decade. So, of course, my local area is not really helping support those prices as it's down more than 5% from its peak a year ago. And it's generally been holding about steady since February. So, look, the time bomb is ticking, though, with the home market, both locally and nationally. I'll be sharing some foreclosure stats and the forecast metrics, so keep an ear out for that. Okay, so now on to our Forecast Friday tables. As we shift to the forecast metrics, please like, subscribe, and ring that bell. And so starting with our metrics, consumer spending is the next week. The Baltic Exchange Dry Index, it's down quite a bit this week. It's up nicely for the quarter, but overall for the last year, it's way down. So net, it's really down significantly. So shipping around the world is really hurt. So we are in a bit of a retail recession. And monthly rail traffic data. Now, this is a metric that usually falls in the second half of a recession. It's been down annually, and it's down month over month, offset a little bit by some quarterly change, but it is definitely showing some of that. And the China Containerized Freight Index, that's another way of measuring really what's China specific, what's going to certain places. Overall, they're down massive. Annually 70.1%. So they are just putting nothing out. So the world is living off of its inventory and just not ordering more right now. Europe, of course, quarterly and monthly is still way down. Europe is struggling. We've actually seen a bit of a bump on the weekly, but we are down big quarterly. To both coasts, so it is still a factor. Freight waves, national trucking, you can see it's down annually, it's down quarterly, and it's down weekly. So the trucking industry is continuing to erode. There's just not much moving. The retail sales index, it's looking pretty good on an annual basis, but overall we see the trend quarterly and monthly is down. The 10-year spread, I wanted to highlight this. It looks good in some ways, and everybody's been talking about it. The Treasury spread is softening. However, we have a chart here that shows a little bit differently and puts it in perspective. We're actually up from a few weeks ago. or the spread has broadened from a few weeks ago. So this is a nasty, nasty indicator right here. And this isn't just indicating a potential recession, it's indicating a severe recession. Uh, by the way, moving on, building permits, it's down overall annually. We had a great quarter. We had a bit of a drop just month over month, but it is despite the fact that the existing market volumes are low, the new home construction is picking up the ball and running with it, and they're through the use of incentives and other things, they are managing to turn units. But the building permits in this housing market, the fact that it's still up shows a lot of confidence by builders, either that or a lot of desperation. Typically, at this part of a real estate cycle and an economic cycle, building permits would not be going up. Durable goods, again, is next week. Oil futures, I updated this. I will update it again in October. But the price is up about $10 a barrel from where it was, or $8 a barrel from where it was in last week's video. But you can see that based on their forecast, they expect the price of oil to be up about 10% at the end of the quarter, and they expect it to be up about 15% year over year from this time frame. That's a negative on the economy because that's often a source of inflation, and that erodes our purchasing power and slows the economy. It's a tax, basically, on economic activity. So the Philly Fed came out this week, and we had an ever so slight improvement month over month, but we're still way off quarterly and annually. This is showing an industrial recession by a significant margin. And last week, or 2 weeks ago, we reported the ISM Purchasing Managers Index. Again, it's been in recessionary territory as well. So we have some noteworthy red on this panel. Moving on to our second panel, we covered retail occupancy and other factors last week. The mortgage applications for new purchases are actually down quarterly, annually, and they were down actually on a weekly basis as well. So, even though building permits are up, of course, mortgage applications for purchases are down. We covered the cardboard boxes and other things last week. The initial claims, it is actually a negative because they are going up. They've been sneaking up, as you can see. All right, we covered manufacturers' items previously. We've got mortgage delinquency and foreclosure stats here. The foreclosure stats, actually, things have improved in the fact that they've dropped. They're still higher than they've been. The mortgage delinquency rate is up slightly month over month, but overall, it's looking good. However, there are still a lot of properties that were struggling, or property owners that were struggling with their mortgage payments. Of course, during the COVID era, there was a moratorium. So there's still a lot of that sitting out there. We look at auto loans delinquent by 90 days or more. It's not updated as frequently as we'd like, but we look at it and it's dropped a little bit. It's definitely not moving in a good direction. This week, we updated the CB Leading Economic Indicator Index. And as you can see, it's been down month over month. It's down quarterly. It's down annually. So these leading economic indicators just aren't looking good. All right, moving on to the third panel. We already updated M2 last week. The index of industrial production, we already know that there's challenges with the industrial sector, and of course, down quarterly and monthly, up slightly on an annual basis, but it is essentially flat. The capacity utilization rate for all industries, this is usually a good indicator. You can see that it had a really recent drop. That's a very significant drop, and it brought the annual into play a little bit more. So we really need to keep an eye on this because this shows a slowing in the utilization. Sales at retail stores, it's generally been flat. It has slightly down month over month. Manufacturing trade inventories, it again was generally flat. It was up annually, but it is, generally flat. It's ever so slightly negative. If I had enlarged it, you would see it's down ever so slightly. Um, a ratio of manufacturing trade inventories. You can see it's down a little bit in the recent month. It's becoming more and more problematic. Change in manufacturing trade inventories is actually looking a little bit better. Index of consumer expectations, a massive improvement, uh, which is very telling from 2022. People are thinking things are going in a little bit different direction. They aren't necessarily looking globally. They aren't necessarily looking at things the same way as some people that monitor real economic conditions, but it feels better. The inflation is down, so that's an improved perspective. The global leading economic index, it is down annually, quarterly, and monthly. It continues its slide. The mature economies coincident leading economic index for the G20. It was doing better in the quarterly outlook, but it is down monthly. On average, it's actually a little bit positive for the year, but it is still a bit of a problem. Commercial bankruptcy filings. We actually didn't get our individual data here. So the commercial bankruptcy filings, they've improved. They've dropped, which is obviously an improvement. But we still see a big increase for the quarter and the annual rates. So it is a bit of a problem. We will keep them, monitoring that. But the trend, hopefully, is our friend here. The Manheim Used Vehicle Value Index. That really shows you kind of what's going on there, and it's not moving in the right direction. It's showing a lot of stress in that industry. Annually, 10%. Of course, the used car vehicle market was really overheated. The prices were way high, so we're burning off some of that. So this is not necessarily an indicator that things are going off the cliff, but we will keep monitoring this one because prices, the trend is downward, and it could be problematic. So with that, I wanted to cover a little bit of information here that's new. Um, so I will, the one last thing I tacked on the end of the third list is an alternate way of measuring economic growth. So as I share the alternate measure here, please like, subscribe, and ring that bell. Okay, so everybody is used to the archaic measure for economic output, which is GDP. Something that is actually a little bit more insightful is the measure of gross domestic income, or GDI. It isn't as convoluted in the same ways that GDP can be. I don't say that to infer bad motives by those reporting the stat for GDP, but there are GDP inputs that are inherently, they just don't tell the whole story. Government spending is in GDP. And that is not tied to production. The economy can go up and down, but government spending isn't directly tied to that necessarily. So, also, since GDP also includes consumption, which includes service spending, retail spending, whatever. So spending, that means inflation driving prices up also increases the nominal amount of consumption included in GDP. These sorts of distortions aren't included in the gross domestic income, or GDI. So let's look at this. In 2020, we had the crash in GDI followed by a quick rebound to recoup what was lost. This was, of course, the pandemic issues and the subsequent reopening of the economy in 2021. It shows, some modest growth here. We had two negative quarters of GDP in the first half of 2022, but we were told that was not a recession. As you may note, that starting in early 2022, gross domestic income declined until a slight bump in Q1 of this year. What that means is that the economy is effectively much slower than GDP has been communicating, because this is supposed to be an alternate measure of output, and they should reflect essentially the same thing. However, there's one problem with this measure, and that's inflation. See, this nominal GDI doesn't reflect that. The real GDI shows what it is after inflation. So here's that. So real GDI, which is not calculated in a straightforward way, like simply taking GDI minus CPI, because that'd be too easy. It shows we've been negative 3 out of the last 4 quarters. So even as inflation has been coming down, GDI has not improved. The average over the last 4 quarters is negative 3.1%. If GDI, which is supposed to be an alternate but valid measure of economic activity, and it's reported by the Federal Reserve, if it's doing that, so what does this negative GDI really mean then? Before I cover its impacts, again, please like, subscribe, and ring that bell. Well, if GDI is what they effectively use to measure a recession instead of GDP, we'd be in a nasty one that started in 2022 and has continued into 2023. We won't have the Q2 data for a couple of months yet, so we don't know really what that's going to be. However, negative 3.1 GDI is typical of a recession. The average decline in GDP during recessions is about 2%. If you look simply at real GDI, so it's apples to apples, and ignoring the Great Recession and pandemic, that 3.1% negative GDI is equaled in the dot-com post 9/11 recession, and not again until the double dip recessions in the early 80s. By the way, the worst recession since 1950 was in the late 50s, and that had a negative 8.8 GDI. So we aren't there. It's not that severe. But we are lasting atypically long for not having a recession declared or reflected in the GDP numbers. We have been negative more quarters so far in 2022 and 2023 than we were in the 2001 recession. So we are clearly in a slowdown, but it's a slowdown that's not quacking like the typical ducks we've seen in the past when we had declared recessions. So, and remember, and this is just amusing and not an accusation, but government spending is in GDP, and this really impacts the numbers. After World War II and the Korean War, the significant drop in government spending really sent the country into severe recessions both times. So we may have some of that buoying our economy right now. I know that a noteworthy increase in hiring recently by all levels of government, state and local governments, that's temporarily inflated employment stats. But that's likely a temporary hiring surge, and that'll probably abate pretty soon. But that's sort of what I mean. These aren't necessarily something that is directly attributable to production. Another example would be, reminding everybody that CPI and some of the other inflation measures that are similar, let's say the costs go up 10%, but you only focus on items that go up 5%. Then after a while, reality is lost over time, by the way. But the fixed incomes from government sources are indexed to these lesser measures of inflation. That means that the individual's real income has eroded over time. It saves the government money over that time, but it lessens lessens the strain to Social Security, but it harms the recipients and the standards of living in the long run. So just keep these things in mind when you look at who is making decisions in government, and also keep in mind that what you look at for how growth, inflation, or these metrics, what you look at really matters. So that is enough for today. Yet another Forecast Friday became a bit more involved than intended, but all of it matters. So, by the way, again, if you believe something is worthy of being on the list, please suggest it in the comments. I thank you and look forward to continuing the journey with you next time. Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.